I was thinking about our comments tonight, I went back to a year ago, and it was looking at the headline from a year ago that Chris had given. We were speaking on April 1st, and the presentation title was Weathering the Storms of Market Volatility. And it just struck me as I thought back to a year ago of how much has changed. And so I titled the comments tonight, Investing Lessons from a Really Difficult Year. As we look back over the past year, it has given us really an opportunity, I think, to um, revisit some of the investing lessons from the past year. The first is that I'd offer is just the value of staying the course. We'll talk more about that in a moment. The benefits of diversification, and then something else really more an innovation, I think, than a lesson, but it's an innovation that we can measure portfolio returns in new ways. So I wanted to just touch upon these 3 points and then open it up for questions. And along the way, if you have a question or you'd like me to clarify something, please just raise your hand and let's be in conversation. So just over a year ago, you know, think back just over a year ago, we started to have this intensifying understanding of COVID and seeing it spread across the country. The economy was shutting down in terms of just in terms of just a reaction to COVID. We had looming presidential elections. We were right on the eve of a 30%, more than 30% drop in the Standard and Poor's. And we just felt like we were on the precipice, I think, of something dark and scary. No one would have ever known that over the next year, 600,000 people would die from COVID and the ravage that it would bring to so many and to the economy. But it was a scary time. And Chris was at a year ago encouraging us to stay the course. We know that is a tried and true truth of investing, but in the midst of these dark clouds, it's hard to do sometimes. So a lesson that we've learned from the past year is that if you had not stayed the course, an investor would have really missed out on significant gains in the markets over the past year. And even year to date, the broad market indexes, the S&P 500, the Dow Jones are up 11%, Nasdaq's up 9%. So we're off to a strong start, but this past year has just been really incredible. And there's a sense of optimism even from here. There's $6 trillion of stimulus that's coming into the economy. We're seeing a GDP growth rate just published today of over 6% and expected to go even higher. We have an accommodating Federal Reserve. There's pent-up demand for all things, especially leisure and travel and durable goods. There was an announcement that the growth in durable goods consumption is up 41%. So had someone, maybe logically gotten out of the market a year ago, they would have missed out. So again, it just underscores the value and the importance of staying the course, even in the shadows of the darkest clouds. I think another benefit or a lesson that we can learn or revisit from the past year's market is just the benefits of diversification. And it's been interesting. The favorites of last year are kind of the dogs of this year and vice versa. You may recall last year, everybody was talking about big technology, Apple and Facebook and Google and Microsoft and others. And they just seemed to just take over the world and the indexes. This year, not so much. Big tech is underperforming, and what we're seeing is a rotation out of big or large capitalized companies into small value-oriented companies. Last year, big tech or large cap companies outperformed small cap value companies by more than 38%. This year, small cap value is outperforming large cap growth by over 11%. So we're seeing a rotation in terms of capitalization. We're also seeing, the normal sort of churn of returns. And what this is this is a table, it's called the periodic table of investments, and it shows the ranked order return of different sectors in any given year. So we would read this, for example, in 2020, you can see that the Russell 2000 growth was the best performing sector at nearly 35%. And all the way down is the S&P 500 value, which was up just 1.2%. That was the worst performing sector. But what's so interesting about a chart like this is um, look at the worst performer in 2020. It was the S&P value. Well, that was the best performer the year before and kind of in the middle of the pack the prior 2 years. So it's really difficult in any given year to predict which sectors are going to perform the best. Last year, energy and finance or banking, uh, materials, they were the worst performers, giving negative returns in some cases. So far this year, they're the best performing sectors. Energy's up over 25% year to date. Um, Financials or banks are up 20%, and materials is up nearly 20%. So it just goes to speak again to the importance of diversification and having eggs in all of these different baskets, so that no matter what the market is, that there's bright spots in the portfolio. And this is one of the things that the Methodist Foundation does in terms of its portfolio construction and maintaining a sector neutral allocation, so that we're not trying to bet on which sector is going to perform the best in any given year. So that's another lesson, I think, from the year, is the importance of diversification and seeing how fast there's rotations in the marketplace. As we think about diversification, obviously there's the types of securities that you would select, but there's also the diversification across broad asset classes between bonds and stocks and cash. And of course, the Methodist Foundation has 3 models that offer 3 different versions of diversification across bonds and stocks. And through that, being able to offer more risk return uh, uh, trade-offs in the model portfolios. So I think this is a good point that we can revisit the model portfolio performance for the 3 models, the main models of the Methodist Foundation, the aggressive, moderate, and conservative. You can see that, especially over a longer period of time, 5 years, 3 years, that the portfolios have really done well relative to the benchmark. These are returns net of fees, so after fees are deducted from the return relative to the blended benchmarks. And the portfolios are providing broad diversification. They're providing a mission-aligned portfolio with low fees. And if you look at just even the last trailing 1 year, those returns have just been significant. Look at the returns relative to the indexes. Of course, the whole market was up, but it's just incredible. A conservative portfolio returning 17%. It's just really a remarkable year in so many different ways. So, one of the last point that I wanted to make was not so much a lesson, but an innovation in how we can look at a portfolio and look at traditional returns of performance, but increasingly we're asking the question of, okay, we have very competitive investment returns, but what impact or what is the portfolio doing in terms of mission alignment? So Chris, let me stop there just for a moment. And I really like this framework that you developed around Wesley's 3 simple rules, and then I'll pick it up after that.
In our tradition, we have this concept of the general rules of the Methodist Church, which go back to the very founding of the Wesleys of the Methodist movement in England, and then as it's translated throughout our Methodist history. And Bishop Reuben Job was one that really codified these general rules as what he called Wesley's 3 simple rules. And you can see those on the screen here. The first one is to do no harm. And the second one is to do good. And we feel that this is a very concise, straightforward, simple way to communicate how the foundation frames the management of the investments. At first, we screen out the companies that have core business activities that aren't aligned with the social principles. And Jim will talk about that a little bit on another slide. And then the second rule is to do good. So we screen for companies that are rating more highly than their peers on environmental, social, and governance factors. So these companies have a lower fossil fuel footprint, for example, compared to their peers. A host of factors that we use in the screening through Sustainalytics when the portfolios are constructed. We believe by putting these together, that helps the church not have to worry about or focus on how to manage investments. Through these principles and through the portfolio construction that we have in these models that Jim briefly overviewed, we think that allows the churches to focus more on magnifying the love of God for the world, which is the mission of the church, is to make disciples of Jesus Christ for the transformation of the world. So we think this is a good way to help other people in the church understand why investing through the foundation is different than you might find with your secular investment advisor that would put a church in 14 different mutual funds without a kind of a coherent way to communicate how the investments are working to do good and that are aligning with our principles. Thank you, Jim.
Well, thank you, Chris. So, Chris had published an annual stewardship report this year that really began to look at performance of the portfolio beyond just financial performance. And as Chris had said, mirroring Wesley's first rule of do no harm, we're able to measure within the portfolio the holdings, both the types of businesses and revenue sources that would go against or not be permitted by the Book of Discipline, but to look at how many companies of those sorts are in the benchmark, and then just to confirm that the portfolios, the Methodist Foundation portfolios, do not own any of those companies. But beyond not doing harm, there's also an opportunity to begin to measure in the portfolio the positive of how we're doing good with the portfolio and aligning the portfolio with the missions and priorities of the Methodist Church. One is around the environment. So for example, here we're able to measure of the approximately $30 million that's invested in the large cap portfolio, what we're able to do is begin to measure what that impact is relative to the index. One is through renewable energy, and it turns out that the equivalent of renewable energy generated annually by the companies held in the portfolio could power about 3.5 million homes a year. There's other measures. For example, again, the same $30 million investment, which the United Methodist Foundation has in these portfolios, brought 59% lower carbon emissions relative to the index. And then you can begin to quantify what that means practically, even to gallons of gasoline. So I think one of the lessons is that there's a real opportunity with new analytics and new research available, really to be more precise in the portfolio construction in terms of its alignment with the Methodist principles, but also to help amplify the good that the church seeks to do. So we'll be doing more of this and trying to bring even greater detail through this type of measurement. But as we look back on the year, we can see again the lesson of staying the course and staying fully invested, even in the darkest of moments. The benefits of diversification And what was the bright shiny thing last year is not so much this year. And that we have ways that we can measure the portfolio and talk about the portfolio and talk about the portfolio to potential donors and measure the way the portfolio has a positive impact in the world.